Today we have returning Maurice Shabazz from eFix Credit Solutions. So we had Maurice on last week as well, and we were talking credit monitoring, credit repair, credit building, and Maurice's company also offers capital business funding in a couple of different forms, or a few different forms actually. I'll let Maurice go into more detail about the different plans and options that he has. So, business credit's really important. Obviously, having the capital to operate a company, or really being shown how to get approved for funding in business, it can get a little bit tricky. And working with Maurice over the last few weeks or so, I've really enjoyed it. Getting to know him better, getting to know his company better. And they have a fantastic company. I mean, Maurice's company is fantastic. They offer valuable resources, not only for business owners, but for us as individuals. And we talked about that last week with credit. So if anybody is struggling with credit, take a look at the credit program that we have inside of the marketplace that eFix offers. But today we're going to focus more on funding, because again, that's super important. Cash is king for most businesses, and just having that capital and that cash flow to operate the day-to-day is super important. And having resources to get it, knowing how to get it, is where eFix can definitely come in and provide some solutions for the folks that we're working with. So with all of that being said, I would like to hand it on over to you, Maurice, and we can go ahead and dive right into the different funding solutions that you guys offer.
Awesome. So let's start. So do you want me to go through each program and kind of explain, what the requirements are, the criteria? Would that be better?
Yeah, I think from what I understand, I know you have at least 2 or 3 different funding options. I know credit lines, as well as actual loans, term loans, and I know you mentioned another one to me that I'm not actually too familiar with. So yeah, if you could just kind of go through and tell us exactly which different options you have, and obviously what the criteria are for both, and then I'll need to get that information from you as well, so we can put that in the marketplace. I don't currently have the requirements up, but that's very important that everybody knows what the requirements are going into a funding resource like you guys provide.
Got it. Okay. So would you like me to also touch on the credit builder program? I think that's one of them that we haven't touched on. Want me to touch on that one last?
Yeah, I think it would be helpful to also touch on that a little bit, because I know the credit builder program can and will definitely tie into the funding side of things for some folks. Absolutely.
Got it. Okay. All right. So, one of the most popular programs that we have is the unsecured business finance program. So the unsecured business finance program is essentially getting business credit cards on behalf of the company. It does require a personal guarantor. So we usually look for a guarantor with at least a 685 score, but ideally we would more or less like a personal guarantor for the company to be at least have a 700 personal credit score or FICO score. That would help out a lot more, because as we apply for different business credit cards, they're going to incur inquiries, and then the score is going to be impacted, and the score is going to they're going to take off points for increase. So we would rather that score to be higher rather than lower. So if they're essentially in the 700s, that's a way better outcome. Now, what the good thing about this program, and why we actually have it, and why we get a lot of clients for this program, is because one thing, it could be a startup. You could have started the business just yesterday, and we could go ahead and get some business lines of credit on behalf of the company. The personal guarantor doesn't necessarily have to be the owner. They could just be a member of the entity, whether it's an LLC or whether it's a corporation, or, if it's a sole proprietor, of course, you can have, several members for a sole proprietor. It's only one member for a sole proprietorship. So, if it's going to be like they're going to use the wife, or they're going to use the business partner, the brother, the sister, or whoever, or the friend, or whoever they use, basically they need to meet the criteria, because that's the person that's going to be used to be the personal guarantor for the company. Now, the good thing about this program is They have zero. A lot of these business credit cards have 0% interest for the first 6 months to 18 months, depending on which financial institution it is. So different ones have different introductory rates for different time periods. So that's a good thing about it. So they don't have to worry about paying any interest for that introductory time frame, whatever it may be, whether it's 6 months, whether it's a year, whether it's 18 months. The other good thing that, clients like about this program is they get large lines of credit based on, and it's generally based on their personal. Let me give you an example. We have a client, and his highest credit card was for $15,000. So clients will usually come in and say, well, how much can I get? And it's usually 5 times the highest credit card that they have reported on their personal credit. So being that he had $15,000, his highest credit card is $15,000, 5 times their highest credit card is a perfect gauge for how much they'll get approved for. So he actually was approved for $85,000. But 5 times 15,000 is essentially, 75,000, right? So he actually got $85,000 in capital. And, some clients come to me and they say, well, these are business credit cards. I actually need a loan. We'll get into that in a minute. But I want everybody to understand, loans require documentation. The unsecured business finance program, which is essentially business credit cards, does not require any documentation. No financials. It's basically stated. Everything on the application is stated. So you don't have to worry about documentation. Like I said, this can be used for startups because if you're a startup, you really don't have any income because you're just starting up. So the company hasn't generated any revenue yet, but we use projections when we're actually applying on behalf of the client. So we usually project it, revenue projections. So basically, that's what we use in order when we apply. So whether it's we project they're going to make $500,000 the first year, $200,000, whatever it may be, their client basically puts that on the application, and we get all that data, and that's what the data we use when we go and apply. So I have, and after this phone call, Jeremy, I'm going to send over an attachment. Well, basically, it'll have all the programs that we have. And basically, they have the criteria and the terms. So let's talk about the terms of the unsecured business finance program. The interest rate could be as anywhere from 5% after the introductory period. It could be anywhere from 5 to 29%. So that's all based on their score, their credit history, and so forth. So because we have clients. Well, after the introductory rate, what will I be looking at in interest? So it could be anywhere from 5% to 5% to 29%. Excuse me. So I'll send all this information that I'm relaying to you is also going to be in the attachment that I'm going to send over. So then the second program that we have is revenue-based finance. So revenue-based finance is based on the revenue that the company has generated. Usually, in most cases, lenders lend 10% is a good gauge for lenders and institutions to lend as far as business loans. So let's say if somebody's making $150,000 in gross revenue, generally they'll lend you $15,000, give you a loan for $15,000. So 10% is usually a good. Sometimes it's 15% for revenue-based finance, from what I've seen in my experience. So with this program, the good thing about this program is you can have bad credit. So you can have a 520 credit score, and you can still be approved for a business loan. You need to have at least $150,000 in business gross revenue, at least 10 transactions per month. So all your revenue each month cannot come from just one transaction. So you need to have at least 10 deposit transactions per month. That needs to reflect on the bank statement. It needs to be acceptable industry type. So, if they have a pornography company, yes, they probably won't be approved. So it needs to be acceptable industry type. They need to be in business for at least 1 year. And so they need to provide at least 6 months of business statements. They need to lease or own their business location, and those are the pretty much the terms to qualify. And then we have the terms. They lend anywhere from $5,000 to $1 million. 3 months to 18 months term. So the term to pay back the loan could be anywhere from 3 months to a year and a half, 18 months. The interest is 1.10 to 1.45%. And as I mentioned before, lenders typically approve 10% of the annual gross revenue. So that's pretty much how that program works. So this program, we're talking about business loans. This is not a standard program. We have several different, we have close to about 100 different a pool of lenders that we actually do this with. Some of them don't have the same criteria. Some of them you can only be in business for 3 months. So some of the criteria can change, but roughly this is the main criteria that we like to go by. So, we have different ones. So if they haven't been in business for a year, we can still work with them because we have other lenders that basically don't require them to be in business for a year. So, different ones have different. But I like this particular program because the interest is low. The interest is 1.10 to 1.451 and 3/4%. So 1.45%. So, excuse me, 1.5, close to 1.5. So 1.45%. So it's really low, the interest, but the reason why the interest is low because it's a short-term loan. So they do need to have bank statements to show proof of revenue. Sometimes they may ask for a tax return depending on, they might want to see what they did last year and see what's the growth for the company. So sometimes they may ask for a tax return. In most cases, they just ask for the 6-month merchant or bank statement. So if they have a merchant, they'll ask for merchant statements. Sometimes they'll ask for both. So it all depends on the structure of the company. And then we have several other ones. We have account receivables and purchase order finance. So that's another one. We don't get as many clients for that. But if your client does have purchase orders, let's say your client works with several different vendors. Let's say Walmart wants to buy 2 pallets of their merchandise. You have Target wants to buy another 3 pallets. Home Depot wants a few pallets. They have different vendors that basically want to purchase their products in bulk. And they don't have enough inventory to cover their orders. So basically, this is a great program for that. But it has to be business to business. It has to at least be 10 to 20 customers that are businesses. The net terms are 15 to 90 days for the invoices. So they like the invoices to be net terms of 15 to 90 days. So they will pull a personal credit report, just to see the creditworthiness of the business owner. You must have at least 1 year in business. So the terms are $5,000 to $20 million. 80% of the receivables are advanced within 24 hours. 20% balance release once the invoice is paid, minus lender fee, of course. Whatever that may be set, it varies for different companies. So there is no personal credit score requirement, but sometimes they will. I have seen them pull a report, but they state there's no personal credit score requirement. So I don't know exactly what they look for there. They haven't ever really shared that with me, but the clients that I have submitted for this program, I never really had an issue with the credit score, or it's never been an issue that I can remember for that. And then what I like to talk about is, and then we have some other ones that we have equipment finance, where basically they can borrow against their equipment. If they want to purchase equipment, they can do that as well. It's a pretty good program for companies like restaurants. They need equipment. They need a oven. They need a dishwasher. They need this, or it can be construction. It can be anything, really, essentially. But a lot of clients that have a restaurant business usually come to me for that. So we have the business owner needs to have at least a 620 score or higher and 2 years in business. In most cases, they require down payment. No bankruptcy. They cannot have a bankruptcy open or discharge bankruptcy within the last 3 years. So they usually prefer that the business owner is a homeowner because they usually like to secure it with the real estate if they can. So the equipment has to be specific to that industry. So you cannot get a pizza oven for a trucking company. So you need to make sure that, whatever the equipment is, it has to be essential to that industry. So they do new and used equipment as well. And it's usually 80% of the auction value. So if they're want to borrow against their equipment, it's usually 80% of the auction value. Their terms, they lend about 10,000 to 2 million, 12 to 48 month term. The interest can range anywhere from 7 to 28%. Then we have our last program, which is the Business Credit Builder program, which is the program that I like the most because in this scenario, we're building credibility on behalf of the company. Now, that's a more extensive program. That's for companies that actually want to build business credit that's not attached to their personal credit, that doesn't require a personal guarantor. It doesn't require their personal credit in order to secure financing on behalf of the company. So basically, we're building credibility on the company and to where the company can stand on its own and get financed on its own without tying somebody personally to it. So whereas if your company has established business credit, your personal assets are protected because you didn't personally guarantee anything. Anytime you personally guarantee anything or you put your Social Security number down on an application, you're basically saying you're liable. So if that company goes bankrupt or it's a situation where you can't pay the bill, it will go back to your personal credit. So a lot of my clients like this because they alleviate the personal liability. Now, let me tell you how this program works. It is a process because it's essentially about 4 tiers in building business credit. And usually it goes in an order of vendor, retail, revolving, and then cash accounts. So what our clients, it's a 90 to 120-day process because we built a lot of these companies from ground zero. Even some established companies that's been around for 10, 20 years, they never built business credit. So we built, established or new companies. It doesn't really matter. One of the main things is when we accept clients into the program is that they don't have derogatories reported under their business credit profile. So our main focus is Dun & Bradstreet, Business Experian, and Business Equifax. Those are the 3 major business credit reporting agencies that we work with and that we build credibility with. So those are the main ones that they access when you apply for business credit or lines of credit. And a lot of people don't understand that when you apply for a business loan, you apply for a business credit card, you apply for anything under the business, they pull 2 reports. If it requires a personal guarantor, they pull 2 reports, which is a personal credit report and also a business report. In most cases, in my experience, just being partnered with different banks and financial institutions, they come back and tell me usually their business reports are blank, or they don't have a score generated. So that goes to say that a lot of people don't know how to build business credit, and the banks don't usually tell you, hey, you can get approved for a business line of credit without using Social Security number. They're not really going to tell you that. They really don't want to put it out there that even exists or that we even offer that because they want everybody to be personally bounded to the debt. They want a personal guarantee so that way they can ensure that they get paid back. So that's why they usually don't put that out there. But let me explain what these clients have access to when they enroll into this program. They have access, by the time we're finished with the process, they have access to about 20 plus accounts. And we're talking about vendor, retail, revolving, and also cash accounts. So we're talking about Apple, Dell, Home Depot, Lowe's, Amazon, gas and fleet cards, vehicle leasing and financing, major credit card, Amex, Visa, MasterCard, So they have access to all these different accounts under their company, and there's several others that I haven't, that I probably didn't mention, but I'm just giving you an idea. Once they build it, and this has nothing to do. They can have bankruptcy, they can have horrible personal credit, but they can build excellent business credit. So it has absolutely nothing to do with their personal credit standing. So I kind of hashed that out in a nutshell, but I hope everybody understands the concept of it. But that's what the Business Credit Builder program entails. We have several videos on it that explain it, explain the importance of it, explains the process. We have tons of videos that explain this whole program. But yeah, we could definitely talk about that in more detail, especially if anybody has any questions. And I'm also going to send all this information over, like I mentioned after the phone call.
Yeah, absolutely. I'd be happy to put those in the marketplace, and so folks can watch those. I do know what videos you're talking about. You have a lot of great videos on the website. I've explored and watched quite a bit of them. So I'd like to just take a moment. Thank you, Maurice, for covering all of those different options that you have. That was a lot of information, valuable. I definitely learned a lot on some of those programs that you offer. I'd like to open it up and see if there are some questions out there. I know some folks might be on mute, so I'll give everybody maybe a minute to unmute if you have some questions for Maurice. I have a couple, but I'm going to wait and see if anybody else does, so I don't steal anybody else's question.
Okay.
All right. Well, maybe not right now. We'll open up for questions.
No. Yeah, we could do it later. That's fine.
So I wanted to ask you, Maurice, in your professional opinion, like some pros and cons against the first couple of programs that you covered. You obviously covered the unsecured business lines of credit as well as the revenue loans. What, in your opinion, are the pros and the cons on those programs? I know, obviously, with the unsecured lines of credit, because it is a line of credit, if you don't use it, then there aren't any payments to make, versus if you get a revenue loan and it's anywhere from, like you said, 3 to 18-month term, you have to make a payment on that because it's a loan. And with the business line of credit, you obviously have a little bit more flexibility. If you're not charging anything to that line of credit, then there's no payment due. So I think that's kind of an obvious one. But what other ones are out there that you generally find with your clients?
Well, the business programs are out there. Is that what you just mentioned? Was that your question? I will make sure I understand the question.
Well, I guess what I was asking is just kind of a comparison between the unsecured lines of credit versus the revenue.
Oh, okay.
Like what kind of situations and different clients would an unsecured line of credit be more suitable for an individual versus a revenue loan, and vice versa?
Okay, got it. Understood. Okay, so thanks for clarifying that. So business credit cards, I'll just make it really simple. So getting business credit cards on behalf of the company versus getting a loan. Whether it's either for personal or business, what a lot of people don't understand is when you get a loan, that's automatic debt. So if your company gets a loan for $50,000, or even if you get a personal loan for $50,000, once that gets reported, it's basically you're on the hook for $50,000. Now, versus you getting let's say Chase Inc. gives you a $50,000 line of credit on a business credit card. Now, that's not automatic debt. The only debt that's reported or incurred is the debt that you use. Whatever you utilize, that's what you're on the hook for. So automatic debt, that's what I like to call it. So when it's automatic debt, that means that basically as soon as it gets issued, you're on the hook for the full amount. And then what happens is it lowers your score because your debt ratio goes through the roof. And then your credit utilization ratio as well. So because you're on the hook for this large debt and it's reported. So basically it's going to lower your score. Whereas credit card or a business line of credit is only reports what you use at that time. So whatever you're using, if you only charge $500 that month or $1,000 or a couple grand or so, basically that's all that's going to be reported. And business credit is a little different than personal credit because the credit utilization ratio For personal credit, it's about 30%. For business, it's about half. It's about 15%. So once you go above 15%, as far as business credit is concerned, it start lowering your paydex score. Because on the business side, we have a paydex score versus on the personal side, we have a FICO or Vantage score. So loans are, there's nothing against getting loans. Loans usually come with higher interest too. That's the other thing to think about when you're getting a business loan in most cases. Traditionally, when you get like an SBA loan or usually, essentially, you don't get no 0% introductory rate when it comes to these loans. So you're going to get an interest rate, and whatever that interest rate is set based on the personal credit score is where it's going to be set. Whereas it'd be great if they had 0% introductory business loans. That'd be great. That'd be a great product, but I haven't seen any. So that's why a lot of the bigger companies, some of the biggest companies that Google, Facebook, they started with business credit cards. If you ever look at their story, they didn't start off with business loans. And because it makes more sense for a startup, especially a brand new company, a startup company, you don't want to have a huge debt starting out. That's the worst thing that you can do when your company is new. And when I say new, I'm saying 3 years or less in business. That's still considered a new company because you have some companies that have finance programs that won't even look at you unless you've been in business 3 years or more. So if you're a new company, you don't want to get huge debt. That's just my opinion, but depending on where you're at, depending on what the finances and the revenue that company is generating, it may make sense depending, but in my opinion, I believe that business credit cards are way better all day. A lot of people say, well, I just need the cash. I know it's business credit, but I just need the cash, or I'm trying to purchase real estate, or I'm trying to do this. Last time, a lot of people that I know that's doing real estate, they're sliding their cards for real estate. People are doing that now. I see people do it all the time. So, and then these cards can be utilized as cash because a lot of them come with check writing privileges. So you can write a check from these accounts because they're business lines of credit. So, so if it's cash, like I said, business credit cards are the way to go. That's just my opinion. In my experience of doing this for over 10 years, business loans are okay, but, I would rather have business credit cards opposed to a business loan.
Yeah, I agree. I think I definitely have been more of a fan of the unsecured lines of credit in business that just typically make more sense. And, and times have changed, whereas before in the past when you had a credit card, it was, it was hard to get cash from a credit, or you'd have to do an advance on that credit card, and that might mean additional fees or higher percentage rates. But it's not really like that so much anymore. And like you mentioned, there sometimes are even check writing privileges on these lines of credit. So it's not as good as cash, but these days, these unsecured business lines are pretty close to cash. It can definitely be utilized and spent just like cash can for most of the things that you're doing in business. Okay, good. So, yeah, I just wanted to kind of cover that. I don't know, all of who's on the phone and how much familiarity there is, with you folks or anybody listening to this in the future. So I wanted Maurice just to kind of talk a little bit, kind of put the two in the boxing ring and let them dish it out to kind of see which one's better. And obviously situations are always different. And even though somebody is eligible for unsecured lines of credit, but like Maurice said, just really wants the cash, that's kind of their call. It might come down to the numbers at that point. Maybe they want the loan because it's a lesser percentage, like Maurice was saying, 1.1 to 1.45. That's a pretty darn good rate versus an unsecured line of credit where it can be anywhere from 5 to 29. But again, there's going to be that introductory rate of 0%. So if they know that there's definitely no doubt in their mind that they may spend $10,000 or $20,000 on this card, but they'll easily be able to pay that back with an introductory period, then it makes perfect sense to just go with the unsecured line of credit, because then they're paying no points at all on that money. It's free money at that point. They don't have to pay any interest on it. So that's fantastic. All right, I'll open up again just really quickly, see if there's any questions, or Vince, if you had any questions or comments you'd like to add in as well.
No, I think we're good. I don't think we have any questions. If you guys have questions while you're talking, you can also put them up there in advance before we ask. Write them up there. If you do, if not, we'll move right on. But why don't we move on to credit building? I think that's going to be a really great subject.
Yeah, absolutely. I know you touched on it, Maurice, and there's a lot of really great info. And if we could go into detail, about that a little bit more, I think that would be great. Because I agree with you. I think there's a lot of business owners out there that just don't realize that they can actually get, business lines of credit and loans directly through the business without ever having to do, a PG, a personal guarantee. And, like you were saying, it kind of sounds like the lenders are somewhat trying to keep that a secret, or at least not a secret, but not, completely throw it out there. But that can be huge. Like you said, there's clients of yours that have been in business 10, 20 years and never had any business credit. And there's a lot of really great, powerful things a business can do if they have a good, strong business credit background.
Yeah, absolutely, Jeremy. I'll go in more detail. No problem at all. Love talking about the Business Credit Builder Program. It's, like I said, it's a great program. So one of the first steps in building business credit is company compliance. You have, I call it company compliance. Some people call it business credit building checklist. But I like to call it company compliance because these things are what lenders are going to look for, and they're pretty basic. And I'm going to send you guys over an attachment that'll have all the compliance as a checklist, but also have some resources in there where you can go to establish these things for your company. So every company needs to have either to build business credit. You can't do a sole proprietorship because the sole proprietorship, we're getting back into being personally liable. And if you're doing a sole proprietorship, that's kind of counterproductive if you're trying to alleviate the personal responsibility. So sole proprietorship is solely responsible. That's what sole proprietorship is. You're solely responsible for the company. If anything happens to the company, if the company gets sued, or the company goes bankrupt, it's going to be attached to your personal because it's a sole proprietorship. So to alleviate this personal liability that that we want, that's essentially what we want to do with this process. We want to start with a corporation, or we want to start with a limited liability company. And some people ask me, well, can nonprofits do that? Yes, because a nonprofit is a corporation. So it can be a nonprofit as well. So what happens when we do this is you need to be an LLC or corporation. You need to establish have your company established in the state in which you reside. There's a lot of red tape with foreign entities. A lot of people say, well, I'm a California resident, but, my company is registered in Wyoming. That's a big risk factor for somebody who's willing to finance you and give you a line of credit because you're in a whole other state operating a company that's based in, all the way on the other side of the country. So if you're just mainly an online company, then yeah, that's okay because all your business is conducted online, so that would make more sense. But if you're a company that actually would have a place of business like a retail space, or your auto shop or something like that of that nature, then yeah, that would be a high risk. So we encourage our clients, even if they do have a foreign entity, to register that company in the state in which they reside in. That's very important because it's a part of being compliant. The second thing, the next thing is several different elements in the compliance. They need to have a website. Every established company has a website, even if it's just an information site. Every company essentially has a website. They usually like to see domain emails. They usually don't like to see the Yahoos and the Gmails and stuff like that. It's better to have an email that's a corporate email that's attached to the domain that you're using for your website. 411 listings. I know you guys at Agora have a program for 411 listing, basically listing local directories online for companies. That's very important because a lot of these, what people don't understand is when you're applying for a business line of credit, the first thing that they do is go Google your company and see what pops up. Even banks are using Google. Just Google your company, type it in, let's see what pops up. Let's see if people are saying bad things about your company. Let's see if there's any business data at all on Google about your company. Let's see what we can find. So 411 listings are very, very important. They have a local threat. Because if you look, I always use my company as an example. If you look at my company, any company that I have actually, and we go in Google one of my companies, they're going to pop them on the first, second page, and third page of Google. Our information is well filtered in 411 directories. So you want to make sure that your company, and a lot of this is just cosmetic. You want to make sure that at first glance that your company is established. So you need to have a business phone line that's attached from your cell phone. You need to have a phone line that's designated just for the business. What else am I missing? We have website. We have the company structure. Back on the company structure, if your business requires you to have a business license, then you need to have one in place. That's one of the things that they're going to ask for later on down the line. Do you have a business license for the company? Some industries don't require it if it's service-based, depending on what city you're operating out of. Some don't require it. But if your industry does require it, you should have it in place. So make sure you have a business license if it's required. So I believe that's the main things. And when it comes to bank account, you need to have a business bank account. They consider that you haven't started business unless you open a business bank account. And some banks look at it as if the day that you open your business bank account, regardless if you've been established for a year or so, you didn't start business or start transacting business until you actually open a business bank account. So it's essential to have a business bank account. I usually recommend that my clients open up an operating and expense account, an income account or merchant account, and a savings. So it makes it really good, easy for your CPA. This account is where we generated all our revenue. This is where our revenue came in. This account where all expenses were paid out of. So it makes it easy to see what came in versus what was paid out, and it makes it really simple to kind of see exactly where you're at in terms of spending and expenses and versus the revenue that you're bringing in. So I usually always recommend that to my clients. Of course, you can do it any way you want to. I just found that to be the best system, so that's why I recommend to my clients. So that's pretty much covers the compliance as far as the company is concerned. So you need to want to make sure that you have that in place before you actually start building business credit. Now, the next step after you have all your compliance in place is to make sure that you have you're registered with the Business Credit Reporting Agency. So you need to get registered with Dun & Bradstreet. You need to get registered with Business Experience and also Business Equifax. So make sure that you're established with all these companies, because if you start building business credit and these companies, especially a startup, if you're a startup, they do not have your business data at all. And if you don't register with these companies and you start building business credit, nothing's going to be reported because they have no data, no profile to report to. If your company is established, after a while, just by public record, they'll have your company data in their system. But for companies that are startups, fairly new, probably been in business for a year or less, every company, whether you're old or new, you should make sure that you're established no matter what, just to make sure that everything is going to be reported, because you can lose a lot of time if you're not registered with the credit reporting agencies and you're building business credit. So it's very key to make sure that you're registered with each business credit reporting agency. Now, once you have that, you have your company compliance in place, you're registered with the 3 major business credit reporting agencies. Now you can start building business credit. So usually, and business credit is different than personal credit. Personal credit, if you go out today and you apply for a Capital One credit card, let's say they give you a credit line of $1,000, for example, that credit card is going to be reported either within the next 30 days or the next billing cycle, it'll be reported on your personal credit, whether you use it or not. Business credit is different. They only report payment experiences. So which means that when we establish accounts, we have to make a minimum purchase. And usually in the beginning process of building business credit, they usually are net terms, whether they're net 15, net 30, net 55. Those are the terms that we have to pay within that time frame for whatever is purchased. So the minimum purchase is $50 outside of shipping. So not including shipping, you need to make sure you purchase an item that is at least $50 or more in order for it to be reported. They cannot report $25. They cannot report $30 or $45. The minimum that they can report to these agencies is $50. So you need to make a $50 purchase for each account that you establish. In the beginning, Tier 1, like I said, it's different tiers. You got Tier 1, you got Tier 2, you got Tier 3, Tier 4. Now, in the beginning, what happens is when you go to Tier 1, we pretty much got to kind of accept whatever accounts we can get established because the company has no credibility at all. So we establish, accounts with different companies. Some of them might be Uline, Granger, Chimplers, just to name a few. So we're going to establish Luke Oil, which is a gas card. So we're just going to establish accounts with these companies. We're going to make minimum purchases in order to generate that paydex score. That way we can get some credibility going. That way we can get some account payment history reported. So that way we can start building that company up and their credibility with these reporting agencies. So that way as we go further through the process to Tier 2, Tier 3, we have established, a certain amount of accounts. On Tier 1, we usually like to establish anywhere from 3 to 6 accounts, ideally 6. The more business credit goes by, it's, like I said, it's different than personal credit. So business credit is a trade line game. So the more accounts and the more responsibility it looks like your company has. So the more accounts that you're responsible for, the more credibility you have. So if it looks like your company is responsible for 20 accounts, then that's some good credibility. I mean, what bank doesn't want to deal with a company that has 20 accounts in good standing? I don't know any. So that makes that's great credibility there. So we usually like to establish anywhere from 3 to 6 accounts for Tier 1. Tier 2, we establish at least another 4 accounts. So that way we have 10 accounts when we go into Tier 3. Tier 3, we establish another 4 accounts, which give us a total of 14. So at Tier 4, that's when the sweet spot where you actually start getting cash accounts, which is what we like to call business credit cards. You also get access to vehicle leasing and financing. We got Ford Motor Credit. We got Ally Car Financing. And, you have access to all these accounts. These are your accounts. A lot of people may come to you and say, hey, I seen a company that says, hey, I could buy business trade lines. Let me tell you right now, if you hear about anybody saying you can do this, you see anything online about purchasing business trade lines, run. Because you're going to waste your money. They're going to charge you about $2,000 to $3,000 for you to purchase these lines of credit that you'll never have access to. And I'm here to tell you, you need at least 14 or more accounts to even get any kind of funding for your company without a personal guarantor. So they're going to sell you 2 or 3 lines for $2,000 or $3,000, and you're going to waste your money because if you buy 14 of them, that's really costly. And I'm going to tell you, a lot of these companies don't report to all 3 credit reporting agencies. They might just report to Business Equifax, or they might just only report to Dun & Bradstreet. What happens with a finance company pulls the other 2 bureaus and they're blank? So I hear a lot of people come to me about that. That's the only reason I mention that. Don't waste your money. This is an organic process that I'm explaining to you. It works every time. Long as you don't have bankruptcy and tax liens and derogatories that report it, long as your business credit reports are clear, it works every single time. So I just want to be clear about that. So, but yeah, that's pretty much how I will, in the future, if you like, Jeremy, I could also do an online presentation for you guys, and I could walk you through it and show you like everything I explained, and I could kind of show you exactly what it looks like, what accounts you'll have access to, and I can explain it in great more detail. We usually like to keep the accounts specific of course, tier one, we got to set what we can get, but as we go through the tiers, we usually like to get accounts that's specific to that business need. So if the client comes to me and say, look, I really want to use the funding to purchase real estate and rehab, properties, so forth. If that's what they want to do, then we will focus more or less on, of course, we always focus on cash because every company needs cash accounts, but we focus more on hardware supplies. So we'll focus on Lowe's, Home Depot, Hardware Express, Tractor Supply, just different ones that'll be essential to what they're trying to do. If it's a medical company, we'll try to focus on medical accounts, although there are not a lot of them, but there are some available. So whatever, if it's a trucking company, we'll focus on gas and fleet cards because we know they need fleet cards because they're running a trucking company. So we'll try to focus on whatever's conducive to the industry that they're operating in.
That's great. Yeah, I know I don't know exactly what the statistics are, but I'd imagine there's probably a lot of business owners out there and just businesses in general who haven't done the things that you just explained, and they can do a lot of really good things with business credit, because obviously you can't talk about the sole proprietor necessarily, but there's a lot of LLCs and Incs out there who there might not be a lot of members of, and they're having to use their own personal credit to kind of run the business. And wouldn't it be nice to not have all that stuff tied to your personal credit when you're running a business? Because then personally you just start building more and more and more and more. So I think that program that you have right there is super important for business owners to get handled. So why not? I mean, you can build credit for your for your actual person, but you can also build credit for the business and then be able to do a lot of great things with it.
Let me add this real quick, not to cut you off. I want to add this in. So what I mentioned earlier, I said, basically companies, when you apply for business credit, in most cases, and you're using the personal guarantor, they pull 2 reports. Now, I have clients that have built their business credit all the way to the top tier, which is tier 4. And basically, they went and applied for, because there are some programs that just require a personal guarantor, no matter how good your business credit is, and that's fine. If you want to personally guarantee and you want to get more funds, there's nothing wrong with that. So I have clients that go and they'll apply for business lines of credit after they have built their business credit up and they have good personal credit. They get way more. I have one client, he got up to about close to $250,000. Because basically his business credit was so good, his personal credit was good, so he intertwined them together and he got more capital. So that, like I said, having good business credit speaks volumes. Because a lot of bankers I talk to, they say, a lot of people come here, they don't have no business credit, they don't have established business credit. They're used to looking at blank reports when it comes to businesses. So if you have that, that's great. And then not even only that, I have my other guy, another client I have, he's up to his 5th corporation now. And he has business credit on all of them. So he's doing really well for himself. He hasn't personally guaranteed everything. He just basically let the company stand on its own credibility. So I just wanted to add that in. I didn't mean to interject like that.
I'm glad you did, because once you have the business credit established, then it's your option as the business owner whether you want to put your personal credit, in the mix or not. Whereas if you don't have any business credit, you don't have that luxury. So you have business credit, and say you can get, $150,000 off your business credit, but you can get $250 if you do a PG. Great, that's your decision at that point whether you want to get that extra $100,000. You don't have to, because your business credit alone has already been able to get you $150. So it's great to have that option to do it, whether on your based on your decision alone, and not be forced into getting capital on your person because you don't have any business credit at all. So I got a couple of questions on the credit building program that you were just talking about. When somebody signs up for that program, are they getting like a portal with step-by-steps, do this, and like progress where they're checking off what's done? And so that's the first part of my question. The second part of the question is, on that first step and second step, are you guys still helping them through all those things. Obviously, you can't go down and open that business account for them, and and there's some certain things that they obviously have to do on their own. But you guys are going to give them, like you said, that kind of that compliance checklist. You have to do these things on step 1, and then step 2, you have to do these. But at what point is the program assisting them, and what items are they solely responsible for knocking out themselves? They just have to do it because there's nothing that you guys can do, about it. Like a bank account, for example, you can't go down and open a bank account for John Smith. He has to go down and do that himself. That part I understand, but just trying to get a little bit better understanding of how your guys' program works and to what extent is the hand holding there.
We actually, we have the cheaper program, which is the do-it-yourself program. Well, basically, we assist in the process and we walk them through the steps. Whether versus us actually doing all the steps, we will coach them and we'll guide them through and we'll help them establish, things. If they have problems, we'll give them 100% support. But really, mainly, it's the responsibility is on them as far as making purchases, paying invoices, so forth and so on. So, in my experience, and not just my experience, a lot of other companies that do the same thing, they tell me the same thing. If you leave it up to the client, they never get through the process. It's such an extensive process, and there's so much entailed in building business credit that the average individual, the first time doing it, and they really don't know anything about building business credit, it's overwhelming, and it's just too much to do, and they're busy, and they just don't have time to learn a new process, and they just don't have the time, to really focus on it. So usually, probably 90% don't get through it when they do the do-it-yourself program. So we still offer it, but basically they're assigned to a credit counselor here at eFix Credit, and basically that person works with you throughout the process, and they schedule a phone call, pretty much based on wherever they are in the process. Okay, look, we established these accounts. I'm going to check back with you in 30 days. After you pay them, we'll see if they're reported, and we'll pull the reports, so forth. So whatever process, part of the process, and they'll basically, they'll still walk through it and guide them and stay in contact with them to make sure that they're getting through the process. And that support is for a whole year. Now, we have 2 other programs which are cost more, anywhere from $3,500 to $4,500, depending on their company compliance. If they got their company compliance in place, then it's $3,500, and basically that covers everything. Well, basically, because there's a power of attorney in the contract, so we establish accounts on the clients we have, and basically we'll make the minimum purchases, and basically we'll pay the invoices. It's all entailed in the process. Client doesn't really have to do anything. We update them through, of course, phone calls, but we update them with all their account data and account info, security questions. Everything is in an Excel spreadsheet shared through a OneDrive. So that way they always have access to their company data and accounts as we establish them throughout the tiers. So they're assigned to someone, and basically our team does the whole process, and they really don't have to do any heavy lifting. We have a package for $4,500 where basically say somebody comes to us and doesn't have a company at all, but they want to start one and they want to build business credit. We do everything, their articles, business license, website. We have everybody in-house that does it, and we do the whole entire process. So over the years, I've basically gotten to a point to where we could hold their hand if they want us to, and they want to do that program. We have no problem with that, whatever they choose. Or if they want us just to do an entire process and they don't want to think about it, just, update me as you go through the process and let me know when it's done. We do that as well. So it's really up to the client. Whatever they choose or whatever they want, it's totally up to them. The do-it-yourself program is at a price right now, $1,750.
Okay. Well, good. Yeah, man. Personally, I would definitely want to go for the one where I just, give you the $3,500 or the $4,500 and say, make it happen, build my credit for me, right? I don't have the time to worry about it, so I can definitely see probably most of the business owners electing to go with that option, just because you're right. Time is very limited when you're running a business. You're working in the business, working on the business, and you have so many hours in the day to do your business work, and you get very little time left over for anything else. So being able to just have somebody take that off your plate for you, I think, is super important.
Absolutely.
A couple of things, and we're right here at the 4 o'clock hour, so we're going to wrap it up here pretty soon. But a few things that you pointed out, and I just want to kind of repeat or piggyback on, is you mentioned how important the listings are. And you're right, Agora does have a service for that. We've had that for a long time, and that's very, very valuable. My belief is that every single business owner should have directory listings. It's basically a phone book for companies these days. I mean, the yellow pages, you're not really getting, people don't use the phone book like that anymore. We used to. But now, like you mentioned, even in the underwriting process for loans, banks are using Google. So if you're a business and you're applying for a line of credit, for a business loan, whatever it is, they're going to go online and kind of do some research and underwrite and figure out what they, and find what they're looking for. But if they can't find you at all, that's not a great place to start. You go in and say, hey, I need a line of credit, and you go, oh, okay, and you fill out an application, and you do all that stuff, and then you got declined simply just because you didn't have a Google My Business, or you weren't, on some of the data aggregators, or whatever the case may be. So that's super important. And another thing that you mentioned that stood out to me as well, which we are huge believers here over at Agora, are the reviews. I know you guys have great reviews for your company, and unfortunately, not a lot of businesses out there have quite the reputation that you have. Agora's got a great reputation. We have great reviews, and we are constantly working with our members, with our business owners, to help them do the same with a product called Sotellus. So I just thought that was very interesting as well, that even the underwriters are looking at what their customers are saying about them. That actually weighs in the decision of whether they're going to get approved for capital. If they go to Google, do they see 50 bad reviews, or do they see 50 great reviews? And so I just thought that was really interesting that you brought that up. And then having a website, obviously, and we do that as well. So those are just a few things that I had kind of written down on my notepad here that I just wanted to piggyback on and reiterate how important just some of those little things are in getting capital, that a lot of business owners probably don't realize that it's factoring the decision that the banks are making, or that the lenders are making.
Right. Absolutely.
All right. So I want to just scroll through the website here just for a minute. I've been on the About Us tab here for quite a while, but I want to flip through some of the other tabs. There are a lot of FAQs. Maurice did a wonderful job of providing quite the number of FAQs, and I think that's really important. So if you guys have any additional questions outside of this call, or clients, definitely reference this FAQ section that we have in here, because there's a lot of questions and a lot of great answers in here. Again, I mentioned he's got great reviews. Here's a section of them as well. And in the credit repair tile that we have in the marketplace, there are other reviews, and there's links to all of their review sites. So Marie sent over links for their Google My Business, for Facebook, for Yelp, for BBB. So if any of your clients or anybody you're talking to ever wants to look them up, all that information's there, and there's a lot of good reviews out there. And the contact information, it's the same as we have over in the credit repairs tile as well. And the commissions. So on the business lines of credit, as well as the revenue loans, and I'm not sure, obviously the credit monitoring, I know that has a different commission structure, and we don't have that in here yet, which we will be working on. But when it comes to the actual loans, to the funding, pretty good commission. So what we're looking at as far as the CV is 3.6% of whatever the funding amount is. So I listed out a few examples, $50,000, $100,000, $250,000, $500,000, and obviously there's plenty of loans that can take place, or lines of credit that can take place under the 50 or anywhere in between these examples. But because in this particular type of product and service, it's not like it's a fixed commission, a certain amount of points based on what that amount is. So the best that we can do on the commission breakdown are some examples. So you guys can take a look at that there. I have 4 examples out there currently.
Jeez.
All right. Well, I want to just kind of open up again for any other final comments or questions that anybody has for Maurice, and then we can conclude the call.
I wanted to ask him, we did a lot here on building business credit, but on the personal, you mentioned a couple things too. You on the building personal credit, you said something about you help people get a card, or can you go into detail a little bit on on some of the personal credit building?
Personal credit building, okay. So we have several different products on the personal side. So a lot of clients that come to us on the personal side, when they're looking to establish personal credit or to restore their personal credit, what happens is they come over, and a lot of them usually don't have a lot of personal credit established because they got into a place, they maybe went to a foreclosure, a divorce, or, just lost their job, and they just don't even want to look at their credit. It's just devastating. They don't want to deal with it. So usually they don't have a lot of personal credit established at that point. So what we do is for somebody, even if the most horrible credit profile, we give them resources to rebuild credit. We have several different resources. We have the credit builder card. We have installment accounts, jury accounts, merchandise accounts that give clients a $5,000 line of credit, no matter what their standing is at the time, basically, and they can still be approved and just basically make a minimum purchase and pay it off, and it will be reported in good standing each month, whether they use it or not. So it helps them build credit. I mean, I see some of the score boosts is anywhere from 50 to 200 points just by doing this. So we have several different resources. We have credit cards. We have installment accounts. We have we have personal loans, but we don't offer them unless they usually ask, because we don't want to put the clients in debt. That's counterproductive in what we're trying to do. So we want to make sure that we're giving them sound accounts that's going to help them rebuild rather than put them in debt. And we do have some auto resources if they need to get an automobile, because some of them, of course, transportation is important. So we have some resources for that as well. So wherever the client is standing currently at that point, we pretty much try to help administer anything that we can, because it's not just credit repair. And that's why I always try to tell people, we want to make sure that we get their credit in a place to where they can move forward. That's the most important thing, not just to where we're just removing negative information. We want to make sure that they're able to purchase the car, purchase the home, whatever it is it may be, because if you have 100 items and we remove every last item, that's not going to do anything for your credit score if you don't have any credibility. If you haven't no good payment history reported, your score is still going to be low, and you're still not going to be able to be financed because you have no credibility that you build with any company or any institution. So, the credibility thing is something that we promote heavily with our program. It goes hand in hand with what we're doing.
That's great. Now, on those credit cards, those are companies you work with directly that give out credit cards basically to help people out.
Yes, sir. Yes, sir. Yeah, we work. We're partnered with several companies. Even the subprime credit cards that you see out there, we're partnered with Discover, Barclay, USAA, Capital One. I mean, the list goes on and on and on. We have close to 200 products. So, we work real closely with a lot of these institutions, So we definitely want to help these clients get to where they need to be.
That's great. Okay, well, good. Is there any other questions out there for anyone? If not, I think we did a good job on this. So thank you, everyone. Any closing comments for you, Jeremy? And we'll close out, and everyone have a great day.
Yeah, I do have a closing comment. Is Maurice and his team, they're currently working on a form or a site for us to complete, not only for the credit repair program, but as well as the business funding program that we covered in today's call. So there isn't anything currently in the Forms tab. It's blank, as you guys can see on my screen. We will have a link in there here probably within the week, I would think, Maurice. And so I just want to give everybody a heads up. In the meantime, if you guys have a client or something that is interested in funding or credit repair, please give me a call, and I will make sure that the client gets connected with Maurice and his team in the meantime until those forms are completed.